This is Friday, January 30th, 2026, last trading day of the month, last day of the week, and silver just did something that should not be possible in a normal functioning market. It fell from $121 to $95, $26, gone in hours. Gold didn't just dip either, it dropped hard. Hundreds wiped off the screen like someone hit delete. If you are watching this right now and your chest is tight, if your brain is screaming, I'm sell, 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 stop. Take one slow breath. Because what you're feeling is exactly what this kind of move is designed to produce. But here's the problem. The numbers don't add up. The story the market is telling you is not the real story. Silver crashed over the week, one of the ugliest weekly drops we've seen in years. And yet right now, at this very moment, you can just go out and buy physical silver like it's sitting there waiting for you. That's the paradox. Perth Mint in Australia pauses sales. The US Mint suspends sales. The Royal Mint in the UK shows out of stock. Dealers in India are failing to deliver. Even Costco, the place that sells everything in bulk, puts purchase limits on silver. Let me say it again so it actually sinks in. The price is crashing, but you can't buy the product. Does that make sense to you? In a normal market, when price collapses, supply shows up. Sellers come out of hiding. Inventory appears. Discounts get bigger. Availability gets easier. That's how reality works. But that is not what is happening here. Here, the price is falling while supply is vanishing. The screen says cheap. The shelves say gone. And when the screen and the shelves disagree, one of them is lying to you. So the only question is, which one? Because if you treat this like a normal crash, you'll do what normal people do in a normal market. You'll react emotionally. You'll make the safe move. And you might hand over the most valuable thing you own at the exact moment the world is quietly scrambling to get it. This isn't just volatility. This feels like a magic trick, a distraction in one hand, while the other hand takes something real off the table. And by the end of this, you'll understand exactly how that trick works. Welcome to the hidden economy. Now, before we go any further, let me show you the first crack in the illusion, because once you see it, you can't unsee it. A few days ago, I put out a video and I said one simple thing. Watch the $117 zone. Not because I'm psychic, not because I have a crystal ball, because markets have memory. And when you've watched enough cycles, you start seeing the same behavior show up in different costumes. At the time, everyone was euphoric. Headlines were screaming new highs. People were acting like silver only goes one direction. And then reality punched the screen. Silver went from $121 down to $95. So yes, this drop was possible. A crash was always on the table. That part doesn't shock me. What shocks me is what happened at the exact same time. While the paper price was collapsing, the physical market started breaking. Not getting tight, not a little delayed, breaking. Mints around the world didn't lean into the dip and flood the market with product. They did the opposite. They paused, they slowed. They put up the temporarily unavailable sign. That is not how a healthy market behaves. And if you miss what that means, you're going to make the most expensive mistake a person can make in moments like this. You'll confuse a number on a screen for the real story. Let me be very clear. This video is not about fear. It's about avoiding a trap. Because when a market moves like this, the crowd does two things. They either panic sell out of pure emotion, or they freeze because nothing makes sense. And that's exactly the environment where wealth quietly changes hands. So here's what I need you to do. For the next few minutes, forget what you think you know about the silver price. Pretend you're seeing it for the first time. Because if you keep looking at this through the normal lens, up, down, chart, candle, headline, you're going to miss the only thing that matters. The mechanism, the plumbing behind the price, the part nobody explains, because once you understand it, you stop being easy to scare. And I'm going to warn you right now, what I'm about to show you is not complicated. It's actually simple. But it's so counterintuitive that most people never even consider it. There aren't one, but two silver markets running at the same time. And right now, those two markets are telling opposite stories. That's why the numbers don't add up. And that's why today's crash is not what it seems. So if you're still here, good. Because the next part is where everything clicks. Most people think there is one silver market, one price, one truth. That's the first mistake. Because there are two silver markets running at the same time, and they do not behave the same way. They don't even speak the same language. The first one is the paper market. This is where the official price comes from. Futures contracts, options, swaps, ETFs, all the digital instruments that trade in massive size every day. This is where banks and funds move billions with a few clicks, where silver is bought and sold like it's a number, not a metal. But here's what almost nobody truly internalizes. In the paper market, most of what gets traded is not silver. It's promises. Contracts that say, I will deliver silver later, or someone somewhere can deliver silver if needed. And most of those contracts are never meant to end in delivery. They get rolled, they get closed, they get offset, they get traded back and forth like poker chips. Think about that for a second. In a poker game, chips fly across the table all night. People win, people lose, the stacks change, but nobody walks out of the casino with a wheelbarrow full of chips expecting to buy groceries with them. The chips are real inside the game. Outside the game, they're just a claim. That's the paper market. Now, the second market is the physical market. This is the real world market. Coins, bars, bullion, metal you can hold, stack, store, and actually deliver. This is where supply chains matter, where mints matter, where refineries matter, where shipping, insurance, fabrication capacity, and inventory matter. And under normal conditions, these two markets are supposed to be connected. The paper price is supposed to reflect what physical silver is worth. Because if paper ever gets too cheap compared to physical, buyers would step in, demand delivery, and the system would force the two back into alignment. That's the theory. That's what people assume is happening. But right now, that connection is failing. It's like two clocks on the same wall showing two different times, and everyone pretends it's fine because the one with the brighter screen looks more official. The paper market is telling you silver is $95. The physical market is telling you you can't have it. And that is not a small difference. That is not a minor dislocation. That is a fundamental contradiction. Because price is not just a number. Price is supposed to be a signal. It's supposed to tell you the truth about supply and demand. So when the price says plenty, but reality says gone, you have to ask yourself a very uncomfortable question. What exactly are you looking at when you look at the price? Are you looking at the value of metal or the value of a promise? Because those are not the same thing. And they only look like the same thing when the system is calm. When the system gets stressed, the difference becomes obvious. Suddenly it matters whether something can actually be delivered, not just traded. And this is why moments like today are so dangerous. When people see a crash, they assume it means the asset is less valuable. They assume it means demand is dead. They assume it means sellers are everywhere. But if the crash is happening in the paper market while the physical market is tightening, then the crash isn't telling you the asset is unwanted. It's telling you the game is being played on one board, while the real fight is happening on another. So here's the fork in the road. You can believe the computer screen, or you can believe the empty shelves. One of them is giving you a real signal, and the other is giving you an illusion. And in a minute, I'm going to show you exactly which one it is, starting with the first piece of evidence that made me stop and say, okay, this isn't normal. The first piece of evidence comes from a place that does not play games. Perth Mint, not a random dealer, not a sketchy website with a low stock banner. This is one of the most established mints on the planet. The kind of name institutions trust because their whole reputation is built on one thing, delivering real metal. And here's what matters. This wasn't posted after the crash, when everyone was rushing to explain the chaos. It happened before silver fell off a cliff, before the panic. While the paper market still looked fine on the surface, Perth sent a notice to wholesale distributors saying demand for silver bullion products was increasing, not decreasing, that they had a large backlog of orders for their 2026 Kangaroo silver coin. And because of that backlog, they were pausing new wholesale orders until February 23rd to catch up. Read the logic of that. A major mint is saying, we have more demand than we can fulfill, and we need almost a month just to clear what's already stacked up. That is rationing behavior. That is scarcity behavior. That is not what you say when you're drowning in inventory and desperate for buyers. And it gets even more telling because they also talk about allocations, monthly allocations. So all regions receive stock. That's the kind of language you hear when something is limited, not when something is plentiful. Now step back and run this through common sense. If Perth Mint is already strained when silver is around $117, what happens when the screen suddenly flashes a 22% discount down to $95? Does demand disappear or does demand explode? Because in the real world, when a product is already hard to get and then suddenly becomes cheaper on paper, it doesn't scare off buyers. It creates a stampede. It creates people smashing the buy button, calling dealers, clearing shelves, taking whatever they can get before the premium jumps again. So the crash didn't fix the shortage. If anything, it poured gasoline on it. And that's the part most people don't understand. The lower the paper price drops, the more violent the physical demand can become, because the real world reads the dip as an opportunity, not a warning. Now, I'm not telling you what to buy or sell. I'm telling you to recognize what kind of signal this is. A government-backed mint doesn't pause orders for fun. They pause because they can't keep up. And if that's happening in Australia, you need to ask a scary question. What do you think the official mint in the United States did when prices started moving too fast for the system to handle? Because what happened next in America is where the illusion gets even harder to defend. In the United States, it didn't look like a dramatic headline at first. It looked like a quiet pause, a temporarily unavailable message, a line from customer service about updating prices. a delay that most people would scroll past and forget. But that's the thing about stress fractures. They don't announce themselves with fireworks. They show up as little weird interruptions right before something snaps. The US Mint didn't suspend sales because demand disappeared. They suspended sales because the price moved so fast the system couldn't keep up without bleeding. Think about what that implies. If you are a government mint and you're selling silver coins priced off the spot market and spot jumps violently, you can end up selling inventory at a price that's already outdated, meaning you're effectively selling at a loss in real time. So what do? You stop, you freeze the button, you update, and then when the products come back, you don't nudge the price. You reprice it like you're trying to slam a door before the stampede gets inside. That's exactly what happened in this script. A coin that was priced around one level suddenly appears again, priced dramatically higher, overnight. Not because silver suddenly became more valuable in the paper market, but because the real-world side of the equation, inventory and replacement cost, was getting dangerous. And here's the part most people miss. When a mint pauses sales during a crash, it's not a sign of weak demand. It's a sign of uncontrollable demand meeting limited supply. It's the exact opposite of what the chart is screaming at you. And that's why this moment matters, because now you have Australia straining, and the US freezing. While the screen keeps insisting everything is fine, it's just a pullback. Now zoom out one step. If the official mint in the United States has to hit the brakes to protect itself, what do you think happens in a place where the system is more chaotic, where dealers take payments first and scramble for metal later? Because that's where the story moves next. India. And what's happening there isn't just tight supply, it's something far uglier. In India, the problem isn't just that shelves are empty. The problem is that the delivery chain is starting to fail in public. And that's the kind of signal you never want to see in any commodity market, because once trust breaks, the math becomes secondary. Here's what this script is pointing at. Dealers are accepting orders, taking payment, and then not delivering. Orders get canceled after money changes hands. Buyers get told out of stock after the transaction is already done. People post screenshots because they can't believe what just happened. Now step back and feel what that does to the psychology of the market. If you're a normal person and you try to buy physical silver and you discover that buying doesn't mean you actually receive it, what do you do next time? You don't relax. You don't wait. You don't say, oh, it'll be available later. You become more aggressive. You start calling around. You start paying higher premiums. You start accepting worse terms. You start hoarding whatever you can actually get your hands on because the fear shifts from price volatility to non-delivery. That's a different kind of fear. Price fear makes people sell, delivery fear makes people grab, and delivery fear spreads like fire because it's not a theory, it's not a chart, it's not an opinion, it's an experience. Once enough people go through that, the physical market doesn't just tighten, it hardens. It becomes sticky. Nobody wants to let go of what they have because they're not sure they can replace it, and that's how you get the paradox you're watching right now. The screen says the price is collapsing, but the real world behaves like the price is rising because availability is what's actually collapsing. Now take India and put it next to the other signals. Perth pausing wholesale orders, the US Mint freezing and repricing, and then you look at the UK, the Royal Mint. This is where the story stops being maybe. Because the Royal Mint isn't supposed to be out of the basic stuff, not the common bars, not the standard formats. When even the most boring, most normal, most always available products are showing out of stock across multiple sovereign mints, across multiple continents, you're not looking at a local bottleneck. You're looking at systemic stress, and then the script does something smart. It pulls you out of the world of finance people and drops you into the world of ordinary life. Costco. Because when Costco starts rationing, you don't need a Bloomberg terminal to understand what's happening. Costco is the place you go to buy in bulk. Their whole brand is abundance, pallets, big boxes. Take more. So if that business is putting purchase limits on silver, it's not because they're trying to be cute. It's because demand is hitting the ceiling of supply, and they're trying to prevent one buyer from vacuuming up the entire shelf. Rationing is what you do when you can't meet demand. Now, here's the uncomfortable part. If Australia is rationing at the wholesale level, the US is freezing at the retail level, India is stumbling on delivery, the UK is out of stock, and Costco is limiting purchase size, that's not a few glitches. That's a consistent story. It's the physical market flashing a warning light while the paper price tries to hypnotize you. And right here is where the script pivots into the most alarming evidence of all, because mints can pause, websites can glitch, dealers can fumble, but vault data is harder to explain away. And the next place it points you toward is the one place where physical flows show up like footprints in fresh snow, Shanghai. And what happened there is the kind of number that makes you sit upright, even if you were half asleep. Shanghai is where the story stops being emotional and starts becoming mechanical, because you can argue with headlines, you can argue with opinions, you can argue with a guy on YouTube saying the market is broken. But you can't argue with metal leaving a vault. That's not a vibe, that's inventory. And in this script, the Shanghai Futures Exchange vault numbers are the kind of numbers that don't just raise eyebrows, they change posture. They make you sit up. The vaults are holding 455 metric tons of silver. If you say that fast, it sounds huge. It sounds like an ocean. But the trick is this: markets don't break because the number is big. They break because the number is small compared to the speed of the drain. Because what happened next is the jaw drop moment. In one day, nearly 27 metric tons were removed. In one day, not a week, not a month. One trading day. That's not a little uptick in demand. That's a truck convoy leaving the warehouse while the sign outside still says, everything is fine. And once you translate that drain into ounces, it becomes even more disturbing, because now you're not talking about a statistic. You're talking about a pace that, if it kept going, could empty those vaults in weeks. Now here's why this matters emotionally, not just logically. Because when physical drains happen at that speed, the story shifts from price discovery to who gets the remaining supply. That's when people stop thinking in dollars and start thinking in possession. And the script pushes the fear exactly where it hurts. China isn't acting like this is a normal commodity. China's acting like this is strategic, like something you don't casually export, like something you secure before the world realizes the shelves are empty. And even if you ignore every opinion in the video, you still have to ask yourself one simple question. If the paper price is crashing, why is physical metal leaving the vaults faster? Why is it moving from public storage into private hands? Because nobody does that if they believe the paper price is real. They do that if they believe the paper price is temporary and the shortage is permanent. And this is where the script gets even sharper. Because it doesn't just say China is buying. It says something more dangerous, that the selling is happening in one place, at one time, in a pattern. It says the dumping is concentrated during US market hours. New York opens, silver gets hit. New York closes, the bleeding slows. Then New York opens again, and the hammer drops again, day after day. If that pattern is real, then the crash isn't just emotion, it's choreography. And the next thing we have to look at is the one question nobody wants to say out loud. Who is doing the selling? And why does it only get violent when America wakes up? Now we get to the part where this stops looking like volatility and starts looking like behavior. Because price doesn't just move, price moves when someone moves it. And the script makes a very specific claim. Nearly all of the heavy selling happened during US market hours. Not when Asia is most active, not when Europe is most liquid, when New York wakes up. When the US session opens, silver dumps. Red candles, aggressive selling, fast drops that feel less like a crowd panicking and more like a button being pressed. Then New York closes and the pressure eases. Sometimes the price even stabilizes or creeps upward in the hours when the West goes quiet. And then it happens again. Open, dump, close, calm, open, dump, over and over. If you've ever watched a storm roll through, you know the feeling. The wind doesn't blow randomly. It comes in waves. It hits the same direction, same rhythm, same force. That's what this pattern is supposed to feel like. And the reason it matters is not because it proves some secret villain. It matters because it changes what the viewer believes they're watching. Most people look at a crash and assume the world is rejecting silver. But this pattern tells a different story. It tells you the selling is concentrated in the paper arena, where contracts can be created, dumped, and closed out like casino chips, while the buying is happening in the physical arena, where metal has to be found, shipped, and taken home. That's the psychological wedge the script drives right into the viewer's mind. One side is selling something that can be created with keystrokes. The other side is trying to get their hands on something that cannot be created with keystrokes. And the script sharpens the contrast with a brutal image. It says the West is playing a video game. Numbers on a screen, digital supply, press buttons, print silver with derivatives. Meanwhile, the East is loading bars onto trucks. Not because they're emotional, because they understand something simple. When the thing is scarce, you don't want a promise. You want possession. So now the viewer is forced into a question that feels almost insulting in how obvious it is. If the screen is screaming sell, but vaults are draining, mints are pausing, and deliveries are failing, who is the screen really designed to serve? And that's where the script does something very effective for retention. It turns the viewer from a spectator into a potential victim. It says, if you don't understand the rules of this game, your fear becomes someone else's discount. You dump your metal at the bottom because a number on a chart scared you. And someone in Shanghai or Dubai happily takes what you couldn't hold. Now, right here is where the story needs one more piece of evidence. Because patterns are persuasive, but markets are ruthless. You need a stress gauge. You need something that tells you whether physical supply is actually tight or whether everyone is just being dramatic. And that's exactly what the script reaches for next. Lease rates, the cost to borrow physical silver. Because when borrowing costs explode, it's not opinion anymore, it's pain. And what the lease rates are doing right now is the kind of pain signal that makes the entire paper price start to look like theater. Lease rates are the market's lie detector. Because anyone can talk, anyone can post a chart, anyone can yell shortage on the internet. But when it suddenly becomes expensive to borrow the real metal, you're no longer in the realm of storytelling, you're in the realm of desperation. The script explains it simply. In normal conditions, borrowing silver is cheap, near zero, fractions of a percent. Because when supply is comfortable, lenders don't need to squeeze you. They'll lend, they'll roll, they'll collect a tiny fee and move on. But right now, the lease rates are doing something that does not belong in a normal market. They've exploded. And the script uses that explosion as a pressure gauge for the physical shortage. Because a lease rate spike means one thing. People who hold metal are no longer eager to part with it, even temporarily. They're behaving like the metal is more valuable in their hands than the interest they could earn by lending it out. Think about that. In a healthy system, holders lend. Markets stay lubricated. Delivery chains keep moving. In a stressed system, holders clamp down. They demand massive premiums to lend even for a short period because they're scared they won't be able to get replacement metal back at the same terms. That's the hidden fear that drives lease rates. It's not, I want more yield. It's, I don't trust replenishment. And when you combine this with everything the script has already laid out, mints pausing, dealers defaulting, vaults draining, retailers rationing, lease rates become the final confirmation that the physical side is not just tight, it's strained. Now, here's where the script tightens the noose around the viewer's attention. It connects the dots into a single idea. For decades, the paper market has been the boss. The paper market sets the price because it's enormous. Futures, derivatives, ETFs, hundreds of millions of ounces of silver traded on screens. But the physical market is smaller, and that imbalance gave the paper market power. It could suppress price, it could whip price around, it could create crashes that feel real. But, and this is the key twist, paper can't create metal. Paper can create contracts. Paper can create synthetic supply. Paper can create the illusion of abundance. But paper cannot mint a single ounce into existence. So the script argues we're approaching a breaking point where the old pricing mechanism can't hold reality down anymore. Either the paper price rises toward physical reality, or the physical market breaks so badly that paper pricing becomes meaningless, and then it hits you with the so what? Because now the viewer has emotional understanding, but they still don't know how to behave. This is where the script becomes very direct. If you're holding physical, don't panic. Don't let the screen bully you into selling the only thing the world is struggling to obtain. If you're holding paper, ask the uncomfortable delivery question. If everyone demanded metal tomorrow, could it actually be delivered? And if you're trying to buy, the script tells you the brutal truth. Good luck, because the premium is where the real price is hiding. Now this part is doing more than giving advice. It's forcing identity. It's categorizing the viewer into one of three types: scared, confused, or the one who understands. And that's not an accident. Because the moment you pick an identity, you're more likely to keep watching to see if the story proves you right. And the story isn't done yet, because now it zooms out. It goes from this week to this decade. It says this didn't start today. It's been building for years. Deficits, stockpiles draining, buffers disappearing. And that's where the bigger picture becomes the trap door under the viewer's feet. And here's the moment the script stops being about today and turns into something heavier. Because a one-day crash is scary. A one-week crash is shocking. But a multi-year deficit is the kind of problem that doesn't disappear when the chart bounces. It just hides, it waits, and then it shows up all at once, when the system has no cushion left. That's what this next section is doing. It's telling the viewer, this wasn't a freak accident, this was the bill coming due. The script says silver has been in a deficit for 5 consecutive years. 5 years where the world used more silver than it produced. And the way it explains it is intentionally simple, because the point isn't to sound smart. The point is to make the viewer feel the inevitability. It says, the world mines roughly 835 million ounces a year, but the world consumes over 1 billion ounces a year, not just for investors, but for real things that don't care about your emotions. Solar panels, electronics, electric vehicles, medical devices, the kind of demand that doesn't politely step aside because a futures contract got smashed. So if demand keeps outrunning supply, the viewer has to ask the obvious question, where did the extra silver come from? And the script gives the answer that makes the entire room go quiet. It came from stockpiles, from vaults, from reserves, from above-ground inventory built up over decades. In other words, the difference was paid for by draining the bathtub. And the bathtub metaphor is not a cute analogy, it's a countdown. New mine supply is the faucet. Demand is the drain. For 5 years, the drain has been wider than the faucet. So the tub doesn't just get lower, it gets dangerously low. It gets to the point where a sudden surge in demand doesn't cause tightness. It causes failure. Mints pause. Dealers default. Retailers ration. Vaults get drained. Because there is no slack left. No emergency stash to tap. No quiet pile in the corner that fixes the problem. And that sets up the next emotional turn. This isn't going to resolve next week. This isn't a weather event. It's structural. It's the kind of imbalance that doesn't heal with time. It gets exposed by time. Then the script leans forward and tells you what it thinks happens next. It says, we're entering a phase where paper and physical diverge even more. The paper price might keep whipping around, down, up, down, because paper can be pushed. But physical becomes steadily harder to get. Premiums rise, availability drops, and eventually the idea of buying physical at the paper price becomes almost laughable, like trying to buy bottled water at the price listed on the shelf after the store has already been emptied. And then, just when the viewer thinks, okay, but has this ever happened before? The script does something smart. It gives historical perspective. It points to 1979 and 1980, the last great silver squeeze era, when paper and physical also disconnected, dealers ran out, premiums exploded, and the paper price had to chase reality. It doesn't promise the exact same outcome, because that would sound like a fairy tale. It says the rules are different now. Players are different. But the core dynamic is the same. If physical supply can't meet physical demand, price has to adjust eventually. Paper can delay it, paper can distort it, paper can stage a magic trick crash, but paper cannot create silver. And that's the tension it leaves hanging in the air. Not will reality win? Reality always wins. The question is when? And the script is about to land the final psychological punch by forcing the viewer to choose which type of person they are in this moment. There are 3 types of people watching a moment like this. And the reason the script does this near the end is simple. It turns analysis into identity, because charts don't change behavior. Identity changes behavior, so it draws 3 boxes and silently invites the viewer to step into one. The first type is scared. They see red candles and their brain does what brains are trained to do: run. They don't ask questions. They don't zoom out. They just want the discomfort to stop, so they sell. Not because they're stupid, because they're human. The second type is confused. They see the contradiction and their mind freezes. Price is crashing, but mints are pausing. Spot is collapsing, but shelves are empty. They don't know what to believe, so they do nothing, and in doing nothing, they let the market decide their outcome. And then the script introduces the third type, like it's a quiet badge of honor, the one who understands. Not because they have secret information, because they can tolerate the discomfort long enough to see the structure underneath the noise. They don't treat the paper price like reality. They treat it like a signal about positioning, fear, and leverage. And they treat the physical shortage like the reality that eventually forces the system to adjust. That's the emotional climax. It doesn't end with, here's a prediction. It ends with, who are you going to be? And then the script compresses the entire video into a single recap that hits like a hammer. Silver crashed 22% this week. During the same week, mints paused, deliveries failed, vaults drained, lease rates spiked, price went down, metal disappeared. One of these things is lying, and the script tells you which one without even needing to say it. Then it lands the final metaphor, the cleanest one in the whole piece. It says this isn't a market, it's a magic trick. Because a normal market behaves one way. When price falls, supply appears. But this market did the opposite. Price fell, supply vanished. And the metaphor is powerful because it's visual. You can picture it. A magician's hand waving one way while the real action happens somewhere else. And now, the viewer feels like they've been shown the secret. That feeling, I finally see what's happening, is what makes them comment, share, and come back. So the ending does 2 quiet things. It invites engagement with a simple battle question, paper or physical, and it promises future updates, which keeps the door open for the next video. Not with a loud subscribe, but with a narrative contract. This story isn't over. And if you want to see the next chapter, you know where to find me. That's the script's final retention move. It ends with certainty about the pattern and uncertainty about the timing. Because certainty makes the viewer trust you, and uncertainty makes them return. So here's the final frame the script wants to burn into your brain. This week, the screen screamed collapse, but the real world screamed shortage. And those 2 things cannot stay true forever, because a price that falls while the product vanishes is not a normal market signal. It's a contradiction. It's a split personality. It's the sound of 2 different realities arguing over which one gets to be called truth. That's why the script keeps returning to the same simple line, like a refrain. The price is crashing. But you can't buy the product. Say it slowly, and it becomes almost embarrassing how obvious it is. If something is truly becoming less valuable, it becomes easier to get. People want out. Supply shows up. Sellers appear. That's what a real market does. But if something becomes harder to get as the price drops, that means the price you're seeing is not the full story. It might be a partial story. It might be the paper story. It might be a story told by leverage, liquidation, and positioning. But it's not the story told by empty shelves. So the script's closing message is not, here's the exact price target. It's not even, this will happen tomorrow. It's a warning about where people get hurt. People get hurt when they treat the paper price as if it's the only reality. People get hurt when they panic sell the one asset the world is quietly struggling to source, and people get hurt when they assume a promise is the same thing as possession. Then it ends exactly where it began, because that's what strong viral scripts do. They loop. They return to the opening paradox, and they leave you with a question that keeps you emotionally engaged after the video ends. Which wins this battle? The screen or the metal? Drop your answer, even if it's just one word. Because the moment you commit to a side, you'll notice the next chapter faster than anyone who's still staring at the magic hand. I'll see you in the next one.